All right, John OG here, and I need you to lock in for the next few minutes because what I'm about to reveal is not financial advice, it's not fear-mongering, and it's not another doomsday prediction you can ignore. This is about a mathematical reality in the FDIC insurance fund that guarantees your bank deposits. And when you understand the numbers, you'll realize that the safety net you've trusted your entire life is built on a foundation that cannot possibly catch everyone when they fall. As of Q4 2025, the FDIC Deposit Insurance Fund holds approximately $128 billion in reserves. That sounds like a lot until you realize that it's meant to cover $10.5 trillion in insured deposits across the entire United States banking system. That's a coverage ratio of 1.22%. For every $100 you think is protected, the FDIC has 1.22 in actual reserves to back it up. The other 98.78 exists as a promise, a guarantee backed by the full faith and credit of a government that is already $36 trillion in debt. This is not speculation. This is not a conspiracy theory. This is publicly available data from the FDIC's own quarterly reports published on their website. And what it tells you is that the deposit insurance system only works if bank failures remain isolated incidents. The moment you have systemic stress, the moment depositors at multiple institutions simultaneously try to claim their insurance, the math breaks down completely. And here's what makes this urgent. We are not in a stable banking environment. Regional banks are sitting on over $500 billion in unrealized losses on securities portfolios. Commercial real estate loans are defaulting at rates not seen since 2010. And deposit flight from smaller institutions to larger banks has not stopped since the Silicon Valley Bank collapse in March 2023. The stress is building, the buffer is inadequate, and your deposits are far more vulnerable than the FDIC wants you to believe. Over the next 26 minutes, I'm going to walk you through exactly how the FDIC insurance system actually works, not how it's marketed to you. I'm going to show you the historical precedents where deposit insurance failed at scale and taxpayers footed the bill. I'm going to break down the current banking stress that could overwhelm the insurance fund. And I'm going to give you the 3 critical strategies you need to implement right now to protect your wealth from a systemic banking event that the insurance fund simply cannot handle. This is not about living in fear. This is about understanding the rules of the game so you can make informed decisions while you still have options. The FDIC insurance fund is not a vault full of cash. It's a statistical bet that not everyone will need their insurance at the same time. And when that bet fails, your deposits become collateral damage in a system that was never designed to handle simultaneous failures. So turn off the distractions, grab a pen, and let's break this down step by step, because what I'm about to show you will fundamentally change how you think about the safety of your bank deposits. Before we talk about what could go wrong, you need to understand what the FDIC actually is and what it actually does. Most Americans believe that FDIC insurance is like a vault, that somewhere there's a pile of money equal to their deposits, sitting there ready to be returned if their bank fails. That is categorically false. And the sooner you understand the reality, the sooner you can protect yourself. The FDIC is a government corporation created in 1933 in response to the banking panics of the Great Depression. Its job is to maintain public confidence in the banking system by guaranteeing deposits up to $250,000 per depositor, per insured bank, per ownership category. The key word there is guaranteeing, not holding. The FDIC does not hold your money. Your bank holds your money, or more accurately, your bank has loaned out your money to borrowers, invested it in securities, or used it as collateral for other financial activities. What the FDIC holds is a reserve fund that is supposed to be large enough to reimburse depositors when a bank fails. Think of it like an insurance pool. Banks pay premiums into the fund based on the amount of deposits they hold and their risk profile. Those premiums accumulate in the Deposit Insurance Fund, the DIF. And when a bank fails, the FDIC uses money from the DIF to pay depositors up to the insured limit. Here's how the funding works in more detail. Banks pay insurance premiums to the FDIC quarterly. The premium rate varies based on the bank's risk category, ranging from 2.5 basis points to 45 basis points annually on total deposits. A basis point is 1/100th of a percent. So a bank paying 10 basis points is paying 0.10% of its deposits per year. For a bank with $1 billion in deposits, that's $1 million in annual premiums. The FDIC categorizes banks into 4 risk categories based on capital levels and supervisory ratings. Category Y banks are well capitalized with strong supervisory ratings and pay the lowest premiums. Category 4 banks are undercapitalized or have poor supervisory ratings and pay the highest premiums. This risk-based pricing is supposed to ensure that riskier banks contribute more to the insurance fund because they're more likely to fail. But here's the problem with this model. The premiums are backward-looking, based on historical risk rather than forward-looking stress. A bank can be well capitalized today and pay low premiums, but if it has large unrealized losses on securities or concentrated exposure to commercial real estate, it's actually high risk. By the time the FDIC adjusts the bank's risk category and raises its premiums, the damage is already done and the bank is on the path to failure. Those premiums go into the DF, and as of the most recent data, that fund holds $128 billion. By law, the DF is required to maintain a reserve ratio of at least 1.35% of insured deposits. We're currently at 1.22%, which is below the statutory minimum, but within the tolerance range that regulators are comfortable with given the current environment. The 1.35% minimum was established by the Dodd-Frank Act in 2010 as a response to the 2008 crisis when the fund went negative. Before Dodd-Frank, the minimum was 1.15%, which proved inadequate. Even at 1.35%, the fund would only have $142 billion to cover $10.5 trillion in deposits, which is still a razor-thin margin. Here's the math that should concern you. In 2008 and 2009, the FDIC resolved 465 bank failures with a total cost to the insurance fund of approximately $88 billion. That depleted the fund from $52 billion to negative $20 billion. Those failures represented about 6% of total insured deposits at the time. If we see a similar failure rate today with 6% of the current $10.5 trillion in insured deposits at failed institutions, the cost would be $630 billion. The DIF has $128 billion. That's a $500 billion shortfall. Now here's the critical question that most people never ask. What happens if bank failures exceed the capacity of the DIF? The FDIC has three options, and none of them involve the FDIC having cash on hand to immediately pay depositors. Option 1. The FDIC can borrow from the U.S. Treasury. The FDIC has a line of credit with the Treasury of up to $100 billion, which can be expanded to $500 billion in extraordinary circumstances with approval from the Treasury Secretary and the Federal Reserve. This means that if the DIF runs out of money, the FDIC borrows from taxpayers to cover depositor claims. Option 2. The FDIC can levy emergency assessments on surviving banks, forcing them to contribute additional premiums to refill the fund. This happened during the 2008 financial crisis when the FDIC imposed a special assessment to rebuild the depleted insurance fund. The problem with this approach is that it drains capital from already stressed banks at exactly the moment they need that capital to support lending and operations. Option 3, the FDIC can issue bonds backed by future assessments on banks. This is essentially borrowing from the future, issuing debt that will be repaid by forcing banks to pay higher premiums for years or decades after the crisis. Notice what's missing from that list. None of those options involve the FDIC having $10.5 trillion in cash sitting in a vault ready to pay claims. They all involve borrowing, future obligations, or forced contributions from an already stressed banking system. This is extend and pretend at the institutional level, and it only works if the number of failures remains manageable and sequential rather than simultaneous and systemic. Let me take you back to the savings and loan crisis of the 1980s and early 1990s, because this is the closest historical parallel we have to a systemic deposit insurance failure. And it's a story that most people under 50 have never heard, which is exactly why it's about to repeat itself. Between 1986 and 1995, 1,043 savings and loan institutions failed in the United States. These were not small community banks. These were institutions holding hundreds of billions in deposits, primarily focused on residential mortgage lending. The S&Ls got caught in a brutal interest rate squeeze during the late 1970s and early 1980s, when Federal Reserve Chairman Paul Volcker raised rates aggressively to fight inflation. The S&Ls had issued long-term fixed-rate mortgages at low rates. But when Volcker raised rates, the cost of their deposits skyrocketed while their mortgage income remained fixed. This created massive losses. And by the mid-1980s, hundreds of S&Ls were technically insolvent, but still operating because regulators were practicing forbearance, allowing them to continue operating in hopes they would earn their way back to solvency. The Federal Savings and Loan Insurance Corporation, the FDIC, was the deposit insurance fund for S&Ls, the equivalent of the FDIC for commercial banks. And by 1987, the FDIC was insolvent. It had approximately $6 billion in reserves to cover an estimated $50 billion in losses from failed institutions. The coverage ratio was 12%, meaning for every dollar of losses, the insurance fund had 12 cents. That's 10 times better than the FDIC's current 1.22% ratio, and it still wasn't enough. What happened next is instructive for what's coming. The government did not let depositors lose their money. That would have triggered a run on every S&L in the country and potentially spread to commercial banks. Instead, Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act in 1989, which abolished the FSLIC, transferred its responsibilities to the FDIC, and created the Resolution Trust Corporation to liquidate failed S&L assets. The total cost of the S&L crisis to taxpayers was $132 billion in 1990s dollars, equivalent to over $300 billion today. The Deposit Insurance Fund did not cover those losses. Taxpayers did through direct government appropriations and debt issuance. The insurance was honored, but not by the insurance fund. It was honored by printing money and issuing debt that future generations are still paying interest on. The lesson from the S&L crisis is clear. When deposit insurance funds are overwhelmed, the government steps in to prevent panic, but the cost is socialized to taxpayers. Your deposits were protected, but you paid for that protection through inflation, higher taxes, and increased national debt. Now let's fast forward to 2008 because the financial crisis provides an even more recent example of deposit insurance fund insolvency and government intervention. During the financial crisis, 465 banks failed between 2008 and 2012. The FDIC's Deposit Insurance Fund, which had $52 billion in reserves in 2008, went negative in 2009, falling to a deficit of $20.9 billion by the end of that year. Let me repeat that. The FDIC Insurance Fund had a negative balance. It was insolvent. There was no money in the fund to pay depositor claims. But depositors didn't lose their insured money because the FDIC borrowed from the Treasury, levied emergency assessments on surviving banks, and worked through the failures over several years. By 2018, the fund was back to positive territory with over $100 billion in reserves. But during the crisis itself, from 2009 to 2012, the insurance fund could not have paid out claims if there had been a simultaneous run on multiple large institutions. The only reason the system didn't collapse is because the government provided unlimited backstop funding and the Federal Reserve provided unlimited liquidity to prevent runs from starting. Here's the specific mechanism that saved the system in 2008. The FDIC invoked the systemic risk exception, which allowed it to guarantee all deposits, including those above the $250,000 limit, at institutions deemed systemically important. This guarantee was not backed by the insurance fund. It was backed by the full faith and credit of the U.S. government, meaning taxpayers. Additionally, the Federal Reserve created emergency lending facilities that provided unlimited liquidity to banks facing deposit outflows. The term auction facility, the primary dealer credit facility, and other programs injected trillions of dollars into the banking system to prevent failures. None of this came from the FDIC insurance fund. It came from the Federal Reserve's ability to create money. The lesson from 2008 is the same as the lesson from the S&L crisis. Deposit insurance works as long as failures are sequential and manageable. It fails when failures are simultaneous and systemic. And in both cases, the ultimate backstop was not the insurance fund, but the government's ability to borrow, print, and socialize losses across the entire economy. Now let's talk about why the current environment is more fragile than either the S&L crisis or 2008. There are 4 factors that make the deposit insurance system more vulnerable today than at any point in modern history, and each one of these factors amplifies the others to create a perfect storm scenario. Factor 1 is concentration risk. The U.S. banking system has consolidated dramatically over the last 30 years. In 1990, there were over 12,000 FDIC-insured institutions. Today, there are fewer than 4,500. At the same time, the largest banks have gotten much larger. The top 4 banks, JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup, now hold over 40% of all deposits in the system. The top 10 banks hold over 60%. This creates a too-big-to-fail problem where a single large bank failure could overwhelm the insurance fund. When Silicon Valley Bank failed in March 2023, it was the second largest bank failure in U.S. history with $209 billion in assets and $175 billion in deposits. Of those deposits, approximately $151 billion were uninsured, meaning they exceeded the $250,000 limit. Let me walk you through exactly what happened with SVB because it's a perfect case study of how quickly a well-capitalized bank can collapse and how the FDIC insurance system breaks down under stress. Silicon Valley Bank was the 16th largest bank in the United States, serving primarily venture capital firms, technology startups, and high net worth individuals in the innovation economy. Between 2020 and 2022, SVB's deposits exploded from $60 billion to $189 billion as venture capital poured into tech startups, and those startups parked their cash at SVB. The bank had to invest those deposits somewhere, and they made a catastrophic decision. They bought long-duration, mortgage-backed securities and treasury bonds with an average maturity of 10 years, locking in yields of 1.5% to 2%. When the Federal Reserve started raising interest rates in 2022, the value of those bonds collapsed. A 10-year bond yielding 1.5% is worth far less than a new 10-year bond yielding 4.5%. SVB's securities portfolio, which had a book value of $120 billion, had a market value of only $76 billion by early 2023. That's $44 billion in unrealized losses, more than double the bank's total capital. As long as SVB could hold those bonds to maturity, the losses didn't matter. But when the tech sector started struggling and startups began burning through cash, deposits started leaving SVB. The bank had to sell securities to meet withdrawal requests, and the moment they sold, the losses became real. On March 8, 2023, SVB announced it had sold $21 billion in securities at a loss of $1.8 billion and was raising $2.25 billion in new capital to shore up its balance sheet. That announcement triggered panic. Venture capital firms told their portfolio companies to pull money out of SVB immediately. Over the next 48 hours, $42 billion left the bank, mostly through electronic transfers and wire requests. By March 10th, SVB was insolvent and seized by regulators. The FDIC was appointed receiver and the bank was shut down. Depositors with balances under $250,000 had immediate access to their funds. Depositors with balances above $250,000, which was the vast majority of SVB's customer base, were told they would receive a receivership certificate for the uninsured portion and would have to wait for the FDIC to liquidate the bank's assets to determine how much they would recover. This created an immediate crisis. Payroll companies that used SVB couldn't make payroll. Startups that had all their cash at SVB couldn't pay vendors or employees. And the panic started spreading to other regional banks as depositors questioned whether their banks had similar unrealized losses and whether they should move money to larger institutions as a precaution. The FDIC had to invoke the systemic risk exception to guarantee all deposits, including the uninsured ones, because the alternative was contagion to other regional banks as depositors pulled money from any institution that seemed remotely similar to SVB. The cost of that decision was borne by the insurance fund through a special assessment on all banks, which raised $15.8 billion over several quarters. But here's the problem. If SVB, which was the 16th largest bank in the country, required systemic risk exception and $15.8 billion in special assessments, what happens when a top 10 bank fails? The math doesn't work. A failure of a bank with $1 trillion in deposits would require the entire DF and potentially hundreds of billions in additional funding from the Treasury. Factor 2 is the unrealized losses problem, and this is the hidden time bomb sitting on bank balance sheets right now. As of Q3 2025, U.S. banks are sitting on approximately $500 billion in unrealized losses on their securities portfolios. These are bonds and mortgage-backed securities that were purchased when interest rates were near zero between 2020 and 2021 and are now worth significantly less because rates have risen to 4% to 5%. These losses don't show up on income statements as long as the banks hold the securities to maturity under held-to-maturity accounting rules, but they represent a hidden capital deficiency. If depositors start withdrawing money and banks are forced to sell these securities to raise cash, those unrealized losses become realized and capital gets wiped out. This is exactly what killed Silicon Valley Bank. SVB had a large portfolio of long-duration treasury bonds and mortgage-backed securities. When depositors started withdrawing funds, SVB had to sell those securities at a loss to meet withdrawal requests. The losses depleted capital, the market panicked, and within 48 hours the bank was insolvent and seized by regulators. The terrifying part is that SVB was not unique. According to FDIC data, over 700 banks have unrealized losses exceeding 50% of their capital. That means if they were forced to sell their securities portfolios tomorrow, they would be insolvent. And there are over 2,000 banks with unrealized losses exceeding 25% of capital, putting them in a highly vulnerable position if deposit outflows accelerate. Factor 3 is the speed of modern bank runs. In the past, bank runs took days or weeks as depositors physically lined up to withdraw cash. During the Great Depression, you would see photographs of lines of people wrapping around city blocks waiting to get their money out. That gave regulators time to assess the situation, arrange mergers, or inject liquidity. Today, with mobile banking and instant transfers, a bank run can happen in hours. Silicon Valley Bank lost $42 billion in deposits in a single day, with most of that happening between 9 a.m. and 3 p.m. Pacific time, as depositors used mobile apps and online banking to move money to larger institutions. By the time regulators realized what was happening, it was too late to arrange an orderly resolution. This velocity makes it nearly impossible for the FDIC to intervene before the damage is done. By the time a run starts, capital is already depleted, and the only options are emergency seizure and liquidation or invoking systemic risk, exception with unlimited guarantees. Factor 4 is the commercial real estate exposure sitting on regional bank balance sheets, and this is the stress point that's going to trigger the next wave of failures. Regional banks, institutions with $10 billion to $200 billion in assets, hold approximately $1.8 trillion in commercial real estate loans. That represents roughly 30% of their total loan portfolios in many cases. Let me give you specific examples of banks with dangerous CRE concentrations, because this is not theoretical. New York Community Bancorp, which has $116 billion in assets, saw its stock collapse by over 40% in January 2024 after disclosing unexpected losses on its multifamily and commercial real estate loan portfolio. The bank was forced to cut its dividend by 70%, raise $1 billion in emergency capital, and bring in new management. NYCB's CRE loan portfolio is concentrated in rent-stabilized apartment buildings in New York City, a sector that has been hammered by rising property taxes, increased operating costs, and rent control regulations that prevent owners from raising rents to cover those costs. As loans mature and property values have declined, NYCB is having to recognize losses because borrowers can't refinance, and the collateral is worth less than the loan balance. Valley National Bank, Columbia Banking System, and dozens of other regional banks have similar CRE concentrations exceeding 300% of their capital. That means if CRE values drop 33%, the losses are larger than the bank's entire capital base. And we've already seen drops of 30% to 40% in office and retail properties, with more pain coming as loans mature. Commercial real estate values have declined 30% to 40% from peak in office, retail, and certain multifamily categories. Over $1.5 trillion in CRE debt is maturing in 2026 and 2027, and the vast majority cannot be refinanced at current interest rates without borrowers injecting massive amounts of new equity. Many borrowers don't have that equity, which means defaults are inevitable. Here's the math on a typical CRE loan that's maturing in 2026. A borrower took out a $10 million loan in 2019 to buy an office building with a 7-year term at 4.5% interest. The property was valued at $14 million at the time, giving a loan-to-value ratio of 71%. In 2026, the loan matures and the borrower needs to refinance. But now office values have dropped 40%, so the building is worth $8.4 million. The loan balance is still $10 million. The borrower is underwater by $1.6 million. And even if a lender were willing to refinance, current CRE loan rates are 7.5% to 8.5%, nearly double the original rate. The cash flow from the building can't support debt service at those rates, so refinancing is impossible without the borrower injecting $3 million to $4 million in new equity. Most borrowers don't have that capital, so they walk away and hand the keys back to the bank. The bank forecloses, takes ownership of a building worth $8.4 million against a $10 million loan, and realizes a $1.6 million loss. Multiply that across thousands of loans and dozens of banks, and you have hundreds of billions in losses that will deplete capital and force bank failures. When those loans default, the losses flow directly onto bank balance sheets. And because regional banks hold such concentrated CRE exposure, those losses will deplete capital rapidly. The FDIC has already put multiple regional banks on its problem bank list due to CRE concentrations, and the list is growing every quarter. Here's the cascade that's coming. CRE loans default, banks take losses, capital is depleted, depositors get nervous and move money to larger institutions. The regional bank faces a liquidity crisis. Unrealized losses on securities have to be realized to meet withdrawals. Capital is wiped out. The bank fails. This pattern will repeat across dozens, if not hundreds, of regional banks over the next 24 to 36 months. And when it does, the FDIC will face a choice. Let the banks fail and potentially trigger contagion, or invoke systemic risk exception and guarantee all deposits with taxpayer backing. Either way, the $128 billion in the insurance fund will be inadequate. Now let's connect all of this to what you need to do right now, because understanding the problem is only valuable if you take action. The deposit insurance system is built on a foundation of assumptions that no longer hold, that bank failures will be rare and isolated, that depositors won't panic and run simultaneously, that the government can always step in with unlimited backstops, and that the political will exists to bail out the banking system again. None of those assumptions are guaranteed. The banking stress is systemic, the unrealized losses are massive, the commercial real estate exposure is concentrated in vulnerable institutions, and the political environment is far less tolerant of bank bailouts than it was in 2008 or even 2020. Here are the 3 asymmetric strategies you need to implement immediately to protect your wealth from the inadequacy of the FDIC insurance system. Strategy 1 is geographic and institutional diversification. The most immediate step is to spread your deposits across multiple institutions and ownership structures to maximize FDIC coverage. The $250,000 limit applies per depositor, per bank, per ownership category. That means you can have $250,000 in a personal account, $250,000 in a joint account with a spouse, $250,000 in a revocable trust for each beneficiary, and $250,000 in a retirement account at the same bank, all fully insured. But don't stop there. Spread your deposits across multiple banks, ideally institutions with different risk profiles. Keep operating cash in a large money center bank like JP Morgan or Bank of America that are systemically important and have fortress balance sheets. These institutions are too big to fail, and the government will never let them collapse because it would destroy the entire financial system. Keep emergency reserves in a highly rated credit union or a well-capitalized community bank with low commercial real estate exposure and strong capital ratios. You can check a bank's financial condition by looking up their quarterly call reports on the FDIC website. Look for banks with Tier 1 capital ratios above 10%, low concentrations in CRE loans, and minimal unrealized losses on securities. And keep excess cash in Treasury money market funds that invest directly in government securities, bypassing the banking system entirely. These funds hold short-term Treasury bills, and your claim is on the U.S. government, not on a bank. In a banking crisis, Treasury money market funds are the safest place for liquid cash because there's no bank counterparty risk. The goal is to eliminate single points of failure. If one institution goes down, you don't lose access to all of your liquid capital. You have redundancy across multiple banks and structures so that you can continue operating while the FDIC works through the resolution process. Strategy 2 is to shift to direct Treasury holdings for large cash balances. Instead of keeping significant cash in bank deposits earning 3% to 4% interest, move into short-term Treasury bills purchased directly through Treasury Direct or a brokerage account. T-bills are backed by the full faith and credit of the U.S. government without the intermediary risk of a bank. Here's why this matters. When you deposit money in a bank, you are an unsecured creditor of that institution. Your claim is on the bank, not on the government. The FDIC insurance is a guarantee that if the bank fails, the government will make you whole up to $250,000. But that guarantee requires the bank to fail first, the FDIC to seize it, and then a resolution process that can take weeks or months. When you hold Treasury bills directly, you have a claim on the U.S. government. There's no bank intermediary. If you need cash, you sell the T-bill in the secondary market and receive the proceeds in your brokerage account within 1 business day. The liquidity is nearly identical to a bank account, but the credit risk is eliminated. T-bills are currently yielding 4.3% to 4.6% depending on maturity, which is competitive with high-yield savings accounts. And the interest is exempt from state and local taxes, which makes the after-tax yield even more attractive if you live in a high-tax state. For operational liquidity, keep 3 to 6 months of expenses in FDIC-insured accounts that you can access immediately for bills and emergencies. For everything else, build a T-bill ladder with staggered maturities, so you always have something coming due if you need the cash. This eliminates bank counterparty risk while maintaining liquidity and earning a competitive return. Strategy 3 is physical precious metals as insurance against systemic breakdown. This is the nuclear option, and it's the one that most people dismiss until it's too late. Physical gold and silver, held outside the banking system, are the only assets with zero counterparty risk. They can't be frozen, they can't be bailed in, they can't default, and they can't be inflated away by central bank policies. I'm not talking about gold ETFs or mining stocks. I'm talking about physical metal that you either hold in your personal possession or in fully allocated, segregated storage at a private vault facility that is not part of the banking system. The distinction is critical. An ETF is a claim on gold held by a custodian bank. If the bank fails or if there's a systemic crisis, your claim is on the bank, not on the physical metal. Allocated storage means you own specific bars or coins that are segregated from the vault's general inventory and from other customers' holdings. If the vault goes bankrupt, your metal is not part of the bankruptcy estate because it's your property, not the vault's property. This is the only way to hold precious metals with zero counterparty risk. In every historical banking crisis, gold has been the asset of last resort. In the 1930s, when thousands of banks failed and deposits were wiped out, gold holders preserved their wealth. In 2008, while banks were collapsing and money market funds were breaking the buck, gold went from $800 an ounce to $1,900 an ounce over the next 3 years as the Federal Reserve printed trillions to bail out the system. Central banks understand this, which is why they've been accumulating gold at record pace. In 2023 and 2024, central banks added over 2,000 tons of gold to their reserves, the highest two-year total since the end of the Bretton Woods system in 1971. China, Russia, India, Poland, Singapore, and Middle Eastern sovereign wealth funds are all positioning for a monetary reset, where gold becomes the settlement layer for international transactions when trust in fiat currencies and the banking system erodes. For individual investors, the recommendation is simple. Hold 10% to 20% of your liquid net worth in physical precious metals. This is not a speculation on gold prices. This is insurance against systemic breakdown of the banking and currency system. And insurance is only valuable if you have it before you need it. The allocation should be split between gold and silver. Gold is for wealth preservation and large value storage. Silver is for smaller transactions and has industrial demand that provides a floor under the price. Both have functioned as money for 5,000 years across every civilization and every currency crisis. Work with reputable dealers, avoid numismatic premiums on collectible coins, and either take delivery to a secure location you control or use allocated storage at a non-bank vault. The premiums on physical metal over spot price range from 3% to 8% depending on the product and dealer, which is a small price to pay for eliminating all counterparty risk. Now let me give you the specific action steps you need to take this week because time is the one asset you can't recover once it's gone. Step 1. Calculate your total FDIC insured deposits across all accounts at all institutions. Add up every checking account, savings account, money market deposit account, and CD you have. If you're above the $250,000 limit at any single institution, you are exposed. Start moving excess funds into additional institutions or ownership categories immediately. Use the FDIC's Electronic Deposit Insurance Estimator tool on their website to verify your coverage. The tool lets you input all of your accounts and ownership structures and calculates your exact insured amount. Don't guess. Verify. Step 2. Open a Treasury Direct account this week. Go to treasurydirect.gov and set up an account. It takes 15 minutes and requires basic information like your social security number, bank account for funding, and contact information. Once the account is open, start buying 4-week, 8-week, and 13-week T-bills to build a rolling ladder. Alternatively, open a brokerage account at Fidelity, Schwab, or Vanguard and buy T-bills through their platforms. The advantage of using a brokerage is that you can sell T-bills in the secondary market before maturity if you need liquidity, whereas Treasury Direct requires you to hold to maturity. Step 3. Review your bank's financial condition using publicly available data. Go to the FDIC's Bank Find tool, search for your bank, and pull up their latest quarterly call report. Look for the following red flags. Tier 1 capital ratio below 8%, commercial real estate loans exceeding 300% of capital, unrealized losses on securities exceeding 25% of capital, and deposit growth that's negative or significantly below industry averages. If you see multiple red flags, that's a sign your bank is under stress. Move your deposits to a stronger institution before problems become public and deposit flight accelerates. Step 4. Establish a position in physical precious metals if you haven't already. Research reputable dealers like APMEX, JM Bullion, SD Bullion, or local coin shops with strong reviews. Start with a small purchase to understand the process, then scale up to your target allocation of 10% to 20% of liquid net worth. For storage, consider a mix of personal possession for immediate access and allocated vault storage for larger quantities. Companies like Brinks, Loomis, and specialized precious metals vaults offer segregated storage with insurance. Step 5. Set up alerts and monitoring for banking stress indicators. Subscribe to the FDIC's weekly failed bank list email, follow financial news sources that cover regional banking stress, and monitor the FDIC's Deposit Insurance Fund balance, which is reported quarterly. When you see the DIF balance dropping, when you see failed bank lists growing, or when you see large banks reporting significant unrealized losses, those are your early warning signals that systemic stress is building. Here's the question I want you to answer in the comments because I genuinely want to hear where you stand. Knowing that the FDIC has $128 billion to cover $10.5 trillion in deposits, do you feel confident keeping the majority of your liquid wealth in bank deposits? Or Does this change your risk assessment? And if it does change your assessment, what specific actions are you planning to take this week? I read every comment, and the collective intelligence of this community is one of the most valuable resources we have for navigating what's coming. If you found this breakdown valuable, if you understand why the deposit insurance math doesn't work in a systemic crisis, and why the 1.22% coverage ratio is a statistical assumption rather than a safety guarantee, then I need you to do two things. First, smash that subscribe button and turn on notifications, because I'm tracking the FDIC's reserve ratio, bank failure rates, regional banking stress, and commercial real estate defaults in real time. When the data shifts and early warning signals start flashing, you'll be the first to know. The banking system stress is building, and the information edge matters. Second, share this video with anyone you know who has significant cash and bank deposits and assumes that FDIC insurance makes it risk-free. The math tells a different story. The insurance fund has $128 billion to cover $10.5 trillion in deposits. That's not a safety net. That's a statistical assumption that most people won't need their insurance at the same time. The question is whether you're going to bet your financial future on that assumption, or whether you're going to position yourself for the scenario where the math breaks down and the only backstop is government borrowing, money printing, and socialized losses across the entire economy. The deposit insurance fund is undercapitalized. The banking system is under stress, and your deposits are more vulnerable than the FDIC wants you to believe. The only question is whether you're going to act while you still have the optionality to move, or whether you're going to wait until the exits are crowded and the liquidity has dried up. I'll see you in the next one. Stay sharp, stay informed, and stay ahead of the curve.